tell the audience about how you got started in real estate. Luke, welcome to the podcast.
Hey, Tanner. Thanks for having me. Excited to be here today.
Yeah, we've got super similar backgrounds. I know you started off as a realtor and now you're in industrial. Take me back to getting started, fresh out of college.
Yeah, that's a great place to start, I think. So I graduated college in 2010, which was sort of in the midst of the financial crisis. Things had unraveled quite a bit at that time. Back then I had thought that I wanted to go into investment banking because just knew a lot of people in it. Seemed like a way to make money quickly at a young age. But those jobs were pretty much dried up when I graduated college. So I kind of took what I could get. I ended up taking an initial job in corporate finance at Rolls-Royce North America, not the car company, but the defense contractor. And that was based in Indianapolis, Indiana. It was very much cubicle life. My entire job was reconciling government contracts. So basically, the government issues a contract, Rolls-Royce delivers on it. There's always discrepancies. So basically, 8 hours a day in a spreadsheet, matching up POs to parts and stuff like that. And it was good experience to kind of, get an insight into what the corporate world looked like, but it just wasn't really for me. I, have not a very operationally focused brain, and that was kind of heavy head down operation stuff. So I ended up moving back to Portland, Maine, close to where I grew up, and working at a tech startup there, really small. They were doing motion analysis software. I was kind of doing finance for them. I was an econ major in college, so not full finance, but kind of, enough to do a little bit of startup finance and
claim to be a finance guy.
Claim to be a finance guy. I ended up wearing a lot of hats, which was cool to work for a small company. But the company wasn't really going anywhere at the time. They've now since gone on to do pretty well, but I just kind of always had an interest in real estate. Knew a few people that were in real estate when I was younger, and a job opened up. This is probably a year into doing this startup to be an executive assistant for a top producing broker, residential broker in Maine. So I took that job, and basically I was his driver. It didn't last long. I also actually, one of the only time I've been fired in my life was from that job. I just realized I wasn't a good executive assistant. Again, just didn't have that brain. But in that process, I got to be with this guy for 8 to 10 hours a day. And one of the main things he did was he did marketing for kind of ground up housing developments in Maine. So I got to sit in on these development meetings, and it kind of exposed me to the investment side of the business, which I was like, wow, this is kind of fascinating, how someone can take a piece of raw land, lay the infrastructure, raise the capital, and then build houses on it and make a profit there. So kind of at that point, I knew that that was sort of the side of the business I wanted to be in instead of brokerage. From there, I did stay with the firm. I left the executive assistant job and just became a broker, selling houses. I was mediocre at it. I mean, enough to pay the bills, but I just didn't see. It was very hard for me to wrap my head around what differentiates one top residential agent from another. And you're so subject to market forces. So in that time, as a broker, I actually teamed up with the guy I was working for's son, who was also in the company, and we decided that we wanted to start flipping houses. So we probably spent 4 or 5 months finding our first property, looked at 100 houses, used some hard money lending and found a house to flip, flipped it. That led to maybe 4 or 5 more flips that we did together. And we did okay on them, won some, lost some, but, enough to make a little bit of profit. And I always, had the goal of owning income producing real estate just because, again, like the speculative nature of flipping, market forces, just not
A little spooky.
yeah, kind of spooky. And the idea of owning an apartment or apartment building that was just kind of income producing if you could buy it right, but using some of the construction skills we learned in flipping was compelling. So yeah, we ended up buying our first multifamily property probably a year and a half into flipping. We did sort of the value add strategy. They were very kind of class C, not designated low income units, but definitely on the lower income side. And
The naturally occurring low income units.
exactly, which was a good lesson in how to manage people and tenants. But we learned that if we put new carpets in the units, painted them, added a few washers and dryers, like we were able to get that was before multifamily really got hot. So we were able.
What year was this, by the way?
This was probably 2015 or 2016, so quite a while ago. And just to give you like an example, in our market, then we could buy, kind of class B minus C multifamily for like 75,000 a door. That same product is now like 170,000 a door. So, yeah, it was interesting. But yeah, we did the value add and pulled some equity out. We got our first investor then, and yeah, that's sort of how I got into real estate, if that makes sense.
It does. Who was that first investor? How'd you come across them?
So our first investor was actually a friend of ours, mother, and she was kind of into real estate, liked what we were up to, and we gave her a really good deal. Like there was no GP LP splits. We just needed the capital. We had a little bit to get it closed. So
Yeah, if any of my friends' moms are listening to this, you know where to find me. We love buying real estate. So
yeah, exactly. And it worked out well, but I mean, we're very appreciative because at the time we certainly didn't have the track record in multifamily. So
yeah, I think giving someone their first equity check is like basically charity. If it goes great, then awesome. But more often than not, it's not going to go according to plan. So always appreciate those people who are willing to bet early on other people's careers. Hopefully it pays off for them on the back end as well. So going from apartments, how'd you stumble upon industrial? Because you got into industrial way before the cool kids did. Like back in 2016, it was very, very, very early.
yeah,
So how'd you get?
that's a good question. It was, I'd like to say that I was smart enough to realize that industrial was going to be the next great asset, but that's certainly not the case. It was kind of by accident. We had done a cash out refi on, we at that point, we had about 37 units of multifamily. We had really good kind of Freddie debt on it. And, we brought up the value enough, raised rents probably 30% across that portfolio. So we had a lot of equity in there that we wanted to, redeploy. So we did a cash out refi and we kind of had this money sitting on the sideline and we were looking to buy more multifamily. But at that time, that 75,000 a door kind of threshold that we looked at was even quite a ways in the past. And they were up to like 100,000, 110,000 a door, which in hindsight, we should have just gone hard on
Bought everything.
But, it was scary at the time. We couldn't get the same returns. And, we just didn't think that we could afford or make deals pencil where we wanted them to in multifamily. So we were kind of twiddling our thumbs for a while. And, we work with one brokerage company in Maine pretty predominantly. And I think that's where we're different than a lot of people that you have on the show is, we've worked with one brokerage company only. I don't know if that's probably inhibits us from a deal flow perspective to some extent, but at the same time, they've also been very good to us. And the brokers kept saying, they've got this industrial building. It was in Portland, Maine. I think it's a good deal. It had a machine shop in it at the time. They had about 6 months left on their lease. It was, I think, $380,000 for the building. So, between us and our investor, we had enough to buy it cash. It was a 10,000 square foot building. So, $38, $40 a foot, somewhere in there.
Somewhere below replacement cost, you would say?
Below replacement cost. It was well located. And, the brokers kept saying, that we think this is a good deal. And in our market then, and the way I always understood it, like, why would you gamble on industrial? Like, coming from a multifamily background, like industrial single tenant building, if that tenant leaves, you're holding the bag. But because it was such a low acquisition cost and we weren't putting debt on it, we finally just took a leap of faith and bought this industrial building. And, we wrote out the 6 months of leasing. Obviously our plan was to take debt on it eventually. And yeah, that's kind of how we got into it.
So how'd that first deal end up? I guess coming from multifamily, there's a little bit of crossover between multi and industrial, but how'd you even know how to underwrite it? And what was the business plan starting versus how it ended up?
Yeah, I mean, that's a good question. I mean, I've always been fortunate that I've had a couple of really good mentors in real estate that have done a lot of deal flow across different asset classes. So in terms of understanding the underwriting, like I met with one of my mentors, a friend of mine's father, and we just like looked at, how you underwrite an industrial building. And one of the first things I learned about industrial is like the importance of carrying, decent reserves, because downtime is sort of your killer in industrial, especially single tenant buildings. If you have 6 months to a year of downtime, you go from being completely occupied and having all sorts of income, no expenses, to being, all the expenses, debt, whatever. So we just sort of underwrote it based on if we found a tenant at market rates, for X number of years. It was pretty simple. And again, we didn't have that
Pretty rudimentary.
It wasn't that scary, but it was definitely a figure it out as you go type of situation.
Yeah, I think that's it's kind of the theme of the podcast, I think, is, you do all these deals, but really, about 85% what you're doing. And the other 15, like, you're just going to figure it out on the way as you go. So how did that deal end up working out then? You ended up getting it leased?
Yeah. So, I mean, I think that's a good segue into how we got into the cannabis side of the business, because that was sort of the end story of that. So yeah, we're sitting on this vacant building. We have it for lease. We're working with the same brokerage company to lease it. We have some income coming in from the machine shop that's occupying half the building at the time. And we're just getting it. At the time, Maine had just legalized medical cannabis. And, we're getting all these knocks on the door from cannabis cultivators. And they're coming in and they're saying, we'll pay you, I think the market rent at the time was like $7-ish per square foot. In the Northeast, all our per square foot prices are annual. I know out West, they do it monthly. So.
Yeah, it drives me crazy.
Yeah. So $7 a square foot was the going rate. And we had guys coming in saying, oh, we'll pay you 10, 11 if you just work with us. And, there came a point where there was so much interest, and that such a premium in rent was almost hard to ignore. And, we would seem like very qualified businesses in the cannabis space were kind of lined up to lease this building. But at the time, I mean, the cannabis industry was also a lot riskier than it is now from like a regulatory standpoint. Colorado had legalized, probably 10 states had legalized at the time, but, there was still a lot of federal risk. You had Jeff Sessions, who was I think he was the attorney general at the time, and he came out publicly and was basically saying that he was not pro-cannabis and had kind of made hints that he wanted to shut the industry down. So there was a lot of regulatory fear there. And obviously, like, the financing side of it was next to impossible. And, our whole business plan strategy with this property was to do a cash out refi, or at least place some debt on it so we could buy more property. And yeah, we just were sitting there, and finally we're like, you know what, we can't ignore this. And during that time period, I met my business partner, Michael, who I work with a lot now. And he had just sold a restaurant business. He had 3 or 4 franchises, had done some flips as well, but had some capital kind of in his pocket that he was looking to deploy into income producing assets. And he approached me actually to be an investor and was like, I'm just looking for some income generating assets. I know you've done some stuff in multifamily, like, you've built up a little bit of a reputation around town. Like, would you be interested in having me as an investor? And I was obviously like, pretty stoked on that because it's rare you get approached by investors.
Yeah.
So he's like, tell me more about what you're doing, more about the business. We ended up talking, and I like the way his mind works so much. It was so much more operationally focused than mine, coming from a restaurant background. And so I was like, why don't you just partner up with me on this, and you don't have to be an investor. Like, we'll just partner on it. That also gave me 50% of the capital back, and, knew we'd be able to buy more buildings. So we put our heads together, and I think you're kind of the same way, Tanner. Like, the idea of doing anything without leverage is kind of a crazy idea. Michael, same mindset. Like, we have to be able to get leverage on this. So we kind of racked our brains, and we put together a deck, and we sort of approached it from the mindset of, let's sell banks on, we're not cannabis investors, we're real estate investors. And, at a low leverage, like, the underlying real estate here is very strong. It's industrial, it's well located, there are plenty of secondary uses. And if we were to underwrite this deal on the rent roll of a conventional tenant, it still, pencils very nicely. So we put together this deck. We went around, we pitched probably over 20 banks in the state of Maine. And everybody basically said no. And we're sitting there like, all right, well, still can't do the cannabis thing. And, finally that brokerage company that we work with, the president of the company knew the president of a bank in kind of interior Maine, a small regional bank about 2 hours away from where we were. And the guy said, hey, I'll come down to Portland and go to lunch with you guys and at least hear you out. So we sat down with him, and we kind of did our pitch on, you're investing in the real estate here. You'll keep good reserves, 60% loan to cost, like low leverage. And begrudgingly, he agreed to lend to us, and at least initially. So at that point, we decided to give it a whirl on a cannabis tenant.
So was every conversation with this bank like the first 20, like, yeah, we'll do it, but it's going to be prime plus 15, or is it like, yeah, it's just a complete non-starter for us?
No, I mean, it's a complete non-starter for us. Every bank gave us the same story. At the time, there was a piece of legislation pending called safe banking, which to this day, 5 or 6 years later, is still pending, has still failed to get through Congress. And that basically would open up banking to cannabis. So every bank was like, we love what you guys are up to. We understand your story completely, but until safe banking goes through, absolutely not. And the risk at the time, and I guess the risk still from like a technical standpoint exists, but just given the growth in the cannabis industry, how many states it's gone to, like, I think at this point, federal intervention would never happen. But at the time, if the federal government were to intervene on a cannabis company, they could seize the buildings as part of like an asset forfeiture move. At that point, the bank has no collateral to collect on. And, you could have personal guarantees and stuff, but to most banks, they just didn't want even the slightest risk of that. And they also, because of FDIC and like insurance and stuff, there were some issues there from the banking side. But, and after this one bank said yes, and we actually got into underwriting, we got into more diligence with them, these same issues came up again. And what we sort of did to try to mitigate the risk is, knowing that was their position on it, was we hired a cannabis like specific law firm at the time, and we actually structured into our leases covenants that sort of referenced federal legislation. At the time, there was something called the Cole Memorandum, which was like a loose piece of legislation basically saying the federal government won't intervene in the cannabis industry. So in our leases, we had like a default clause that basically said, if the Cole Memorandum gets removed, like in theory, we have a right to evict the tenant. So the thought process was, if there is federal intervention at all, this gets removed, we can be a step ahead of it. And that sort of lease structure was ultimately what gave the bank comfort to lend to us.
Interesting. And were they, when you say comfortable, were they, yeah, we'll do it for a little bit more, or was it just regular terms compared to, if let's say a welder was in there?
it was not crazy terms. It was probably 150 to 200 basis points above where conventional lending was at the time. It was a loan to cost of 60% was the highest they would go. So not loan to value. And then they sort of had default clauses in their loan language that mimicked what we had in our lease language, that basically they could do it due on demand, like if anything happened regulatorily in the industry. And then together we developed compliance standards. So we had them in our lease, they had them in their loan docs. And that was with this law firm that we worked with at the time, basically looking at the licensure of the tenant, certain financial metrics. So every year we would sort of re-underwrite the tenants in our buildings from a compliance and from a financial standpoint. And kind of all of those mechanisms is what helped them get comfort and also helped us kind of gain comfort around the tenants that we were putting in at the time.
And were they all, how were those tenants? Like, typical business underwriting as you're looking at historic financials, were they operating in other states, or did they come to you for their first location with a duffel bag full of money, or how did that work?
Yeah, I mean, it was a mix. It was definitely a mix. Overall, we had great luck with the tenants that we placed. We had a few that were very challenging and didn't work out as we thought. But I mean, yeah, the duffel bag full of money thing was a real story that actually happened. Cannabis, you had a lot of great cultivators, but they didn't really have any business experience, and who knows where they got their money from. So we would go to these guys and say, we need to see a P&L, we need to see balance sheet, we need to see, we need to look at your tax returns. Like, we need to really underwrite you and make sure that your, sources of financing, et cetera. We had this long checklist that we went through, and I had one guy like begging me to lease the building, and he showed up in a black Mercedes. And, early on in the cannabis industry, too, it was very much a gold rush. A lot of people talking the big game. Everyone's going to be a billionaire, blah, blah, blah. And he just opens up the trunk of this Mercedes and unzips 2 duffel bags in the back, and it's full of cash. And he said, I don't know, like, I don't really have strong tax returns. I don't really have a strong, personal financial statement, but he's like, this should give you enough comfort to lease to me. And I was like, as enticing as that is, no, like, legitimate operators in here.
Yeah. Kind of a technical question on that. Did these guys require like a lot of power or heavy TIs, or were they, pretty straightforward from, leasing perspective outside of the cannabis use?
Yeah, that's actually a really good question. And the answer to that is and this is sort of how we structured the deals with them, is they did require a lot of power. They required 1,000 amps, 480 volts. So a lot of the buildings, that was sort of our value add, was to upgrade the power. And they would put comprehensive, TI themselves into the building, but we structured it that we would do shell, roof, and power. And that was kind of it. Anything interior was on them. And that's kind of what made it a good model initially, is they would put 1 to 2 million of their own capital into the build outs of these.
Their own?
Yeah, their own, or investors, or whoever it was. But, that the scope and scale of the build out that they did, that unless they go out of business, they're not leaving your property. And, we've sold most of these assets at the time. I mean, since then, but overall, the relationships with the tenants were really good, and good operators in the cannabis industry were, sophisticated, smart, talented business people is sort of what we came across. Key word, though, is good operators in the industry.
Yes. So why is it that you're moving away from it? Is it you prefer other assets, or want to divest from the cannabis risk?
Question. Yeah, I mean, so like any gold rush, like within the cannabis industry, at first, like, the businesses were so profitable, and I'll kind of preface that on that, our tenants were cultivators. So really they're growing cannabis, and it's a commodity at the end of the day. So early on, like, there was so much demand and not a lot of supply, and Maine was a limited license state at the time. So that means they would only issue a certain number of licenses. So that really kept the supply and demand fundamentals in balance. And then they pulled away the limited licensure, and like anything, like more entrants came into the market. There was more product being pushed into the market. Pricing was coming down, and now it's just not as lucrative of an industry as it was from just from a tenant financial standpoint. So we kind of saw the writing on the wall with that. Said they're going to pull licensing. It's really not, the barriers to entry to growing cannabis are not that high. And, we kind of looked at what had happened in other mature states like Colorado, California, and you saw pricing pressure really hit a lot of cultivators. So we kind of wanted to get ahead of that and start selling some of these assets. Also just a tricky industry to operate in. And we use cannabis to sort of segue into conventional industrial, but we learned that we kind of like conventional industrial more. But to anybody listening that's interested in cannabis, my advice would be find states that are limited license. Like, we looked at Arizona pretty heavily. We didn't do Arizona, but in Arizona, they're not ever going to, issue more licenses, or if they do, there'll be very few. So if you're a landlord to a top cultivator in Arizona, like that business is going to be a strong business for a long time. They're going to be able to maintain their rent obligations. The pricing pressure doesn't exist. So I don't know, kind of a long-winded answer there, but I don't know if that makes sense.
I think that's good. So let's segue into kind of the deals that you're looking at now. If you're getting away from the cannabis industry, or you've gotten away from it, what types of deals are you chasing now? Are they still in Maine, like still industrial?
Yeah, we're pretty much all industrial now, mostly in Maine. We're looking kind of in Massachusetts, other northeastern states as well. We did kind of segue, like I'd say most of the cannabis dealings was like 2 years plus ago. So in the past 2 years, we've been really focused on sort of Class B, smaller industrial buildings. One deal we did when we still had a lot of cannabis assets, or I did, and this is how I met my other business partner, Mark, was there was a vacant warehouse, industrial building, 35,000 square feet in South Portland, Maine, that I'd gotten under contract. And I was actually looking at it as a cannabis asset at the time, but it was fully vacant. I was working with the bank. The bank wouldn't close the deal as a vacant building or give me financing. Mark at the time was someone I used to compete against on a lot of different buildings. And he was kind of waiting in the wings to buy it if it didn't work out for me, but also would run into the same issues with financing. So eventually we ended up sitting down for coffee and discussing partnering up and coming together to have enough capital to purchase the building. And we did that. We bought it vacant, and we were kind of looking at cannabis cultivators to lease it to, but we ended up leasing it to a drywall supply company, and we signed a 7-year lease or an 8-year lease, pretty long lease on it for the full space. It leased up within 6 months. We were going to go back to the bank and refinance it, but we ended up getting an offer on it from an investor from California, just as a stabilized asset. And, we had a really nice profit on it. And that sort of opened my eyes to how you can add value in industrial buildings outside of cannabis. And we ended up, 1031ing that building. We bought 2 other assets from it. Another one was very mismanaged. We ended up leasing it up, converting gross leases to triple net leases. We expanded the building. We maximized the laydown. This was like a 70,000 square foot building. And we ended up doing a major refi on that. And that one deal from the drywall supply company, with the same group of investors not taking on any other capital, has led to we did about 3 other deals, and some of the better deals that we've done from that initial capital base. So that's sort of how we diversified out. And, also from an investment standpoint, cannabis was great from a yield perspective, but we've learned that, there's a lot of ways to have more stabilized assets without kind of the headache and risk. And we just got lucky that we sort of stumbled into when industrial has sort of become one of the darlings of real estate asset class.
All right. So moving away from the cannabis deals, one of the questions or one of the topics that I wanted to touch on is, tenant improvements. How do you manage those capital accounts? Because with coming from the apartment world, your tenant improvements are like carpet, paint, appliances on like the high end. But with some of these tenant improvement allowances with these industrial deals, they're, $1 million, and capitalizing those can be difficult even with a great tenant. So let's talk about that defense contractor deal that you did. I believe it came out of that 1031 exchange through the refi proceeds. So let's walk through that deal.
Sure. Yeah. Happy to talk about that deal a bit. So, yeah, you're correct. That was, we did the 1031 exchange. We bought 2 buildings with it, one of which we were able to add significant value to. We bought the building for about $45 a square foot. And we put about 15 a square foot into capital improvements on it. We painted it, new siding, we improved the lot. And then we did a lot of structural improvements as well in terms of leases. We brought a lot of leases to triple net for the smaller tenants. We actually were able to fully occupy that building at about 30% office space. We were able to completely occupy the office space by, just doing carpet squares, painting it, and offering it at a rate that was compelling, significantly below market for other office space, but, helped the deal pencil. So yeah, we did a big capital improvement plan on this asset, got it fully leased up, got it stabilized. We were able to kind of maximize it was about a 12-acre lot. And just to segue here, just give a little tip for people that are interested in industrial, like one thing that we've found has been very helpful from a leasability standpoint is oversized lots. So we always try to look for buildings with a lot of laydown space. And that's good from a leasability standpoint because not only does it allow for a lot of uses, but you can also monetize some of that extra space for outdoor storage. Or we had an auction company that we were working with that just used part of the lot to store trucks and RVs and stuff like that on. But yeah, we did a lot of improvements to this asset. We brought it up to kind of market value, refied it, got it appraised, it appraised for over $100 a foot. I think we were at like 115, and, convinced the bank to give us a pretty decent cash out on it. And from that, we went and bought another industrial building. It was a 50,000 square foot building. At the time, it had a cold storage user in there, a company out of California. So it had, kind of freezer panels and stuff had been outfitted for that use. But the company was kind of going through some restructuring and just decided that owning a cold storage or leasing a cold storage facility in Maine from a distribution perspective didn't make sense. But they were well capitalized. The lease in place that they had when we bought it was strong. So they had about 5 years remaining on their lease. They were trying to sublease at the time to kind of just reduce their burn. They were having a really hard time subleasing because, for the same reasons, there just were not a lot of cold storage users in the market. But they were getting approached by a lot of, kind of conventional industrial users. The issue was getting the building back to kind of a core and shell industrial building from a cold storage building. So what ended up happening was a tenant approached them. They wanted a 15-year lease on the building. It was a defense contractor, but they needed about $1.5 million in TI to occupy it. Obviously, the company didn't want to put that in to just for 3 years left of their lease obligation to reduce their burn. So they approached us about a direct to landlord lease. And what we ended up doing, like the long and the short of it was, they were going to need the $1.5 million from us as well. So we approached the company had about $3 million left on their lease obligation at the time, the cold storage unit. We approached them and basically offered them a buyout of their lease for 50 cents on the dollar, which was about $1.5 million, to basically release them off their lease obligation. We then took that $1.5 million and used that as the TI expense for a direct to landlord lease with the defense contractor. And we put that in, funded the TI, signed a 15-year direct to landlord lease with them, which is, 15-year lease with a public company is sort of the gold standard in industrial. And then we had to fight with the bank a little bit.
Yeah, it doesn't get much better than that.
They obviously wanted to reappraise the building, and there was a timing issue where, the defense contractor was really eager to move, and we didn't have time to wait for an appraisal to come through. So we basically did a side note with them where we agreed if there was a deficiency in appraisal, we agreed to cover it from an equity standpoint. Silly because the chance of that happening was pretty low with such a better, more stabilized tenant. But then on the flip side, we also got them, if there's upside, we also agreed to cover our leasing commission, which was a 15-year lease. So I don't know if that is sort of what you were looking for in terms of basic structure of that deal, but I think that's the one you were talking about.
All right. So obviously that was a great deal. Let's talk about what you're looking for now. And I think let's focus on kind of why limited partners should put their money with you out of all the places in the world that they could put their money.
Wow. Okay. That's a good place to discuss, I guess. That's pretty loaded question. And yeah, I mean, I think what we're focused on now, we're still very much focused on smaller Class B industrial. Our sweet spot is sort of between, 10,000 and 50,000 square feet, with spaces almost down to 2,500 square feet. And we like those assets a lot. And sort of our whole approach and our whole strategy is to kind of bring commercial real estate management and operational expertise to smaller assets. And, we think there's a lot of value and a lot of yield to be created there because it's such a fragmented space. Most of the deals we go after are owner users where we do sale leasebacks, or, it's maybe someone who sold a business, has a little bit of capital, but bought an industrial building. It's kind of a one-off investment. And, the markets that we operate in, that's the majority of the ownership of the product that we go after. And, whereas a lot of private equity companies, real estate private equity companies, go after bigger assets, they're dealing with larger corporations. They can really bring a lot of kind of high finance expertise to things. But where we think our sweet spot is, with our team, both in Maine and New York, we have that finance kind of background, but we also have great operating partnerships for boots on the ground to manage these assets. And really the smaller assets, the multi-tenanted buildings, that management expertise, kind of hands-on approach, from what we've seen, has kind of been worth its weight in gold. You're dealing with small businesses, you're dealing with more management intensive industrial buildings, and to have those kind of personalized relationships, from the tenant perspective, but also from the lending perspective, from the construction perspective, is sort of, I think, what gives us our differentiated edge over just like ABC real estate private equity company. And a lot of that's been possible. And we haven't really talked too much about this, but, Chimney Pond Capital is my company. That's sort of the parent company. Like, our method has worked through doing joint ventures with great local operators, helping them grow their businesses, helping them scale, and, also helping us kind of get footholds into markets and gain market share. So I don't know if that answers the question, but happy to talk more about it.
Yeah, we'll dig into it a little bit more. One of the questions I have is regarding those sale leasebacks. How do you structure those deals? So, let's say I'm a seller and you're a buyer. I want to lease back my building, but you just paid me $5 million. Why don't I just go right into the sunset? Like, how do you underwrite tenants, specifically not public tenants? And two, how do you get...
Well, if you've just taken $5 million in your pocket, and a lot of these, owner users own their real estate debt free, then I'm going to have a nice PG of my lease with you on it. So, that's going to help kind of keep you incentivized to meet the lease obligations. But I mean, look, the reality is, and what's worked well for sale leasebacks for us, is a lot of these business owners want some early liquidity. They're looking at retirement, but they're just not quite there in the stance of ready to completely wind down their business. So what we're able to do is we're able to come in and we're able to offer them liquidity through their real estate. And it gives them more time to figure out sort of how to transition the business. And I mean, we love working with these people. We get to see fascinating businesses that are so under the radar. So many kind of pickup truck millionaires that you would never expect that have just built these incredible companies. And so, our goal is not to go in and maximize value out of the gate. We want to work with these owners to help them transition. And so what we'll do is we'll structure a pretty favorable lease deal we'll probably give a more favorable rent out of the gate than market. And, with a lot of these, it's like a 2 to 3 year transition. So we're willing to ride out a little bit of a lower lease rate to sort of help them transition. And then at that point, we'll bring the rents up to market, or we'll, bifurcate the building, do multi-tenant strategy. But that's sort of how we approach those deals.
Okay. And how are you typically capitalizing those deals? Is it, you said you started off with kind of friends and family money. Are you taking, do you have a fund? Are they still deal by deal? How do you think about debt, like that type of stuff?
Sure. Yeah. So, we've done everything deal by deal. We've built up not a large, but a solid LP base at this point. We've been fortunate to have a few very strategic LPs, some from real estate, some from just general entrepreneurship background, that have been with us, kind of since the early days, have been great advisors, great mentors, and also just, are usually interested in the deals that we're doing. So everything's been on a deal by deal syndication basis to this point. Our two strategic LPs are really encouraging us, and this is something I've been working on in New York a lot lately, in creating some sort of capital vehicle, whether that be a fund or an opco structure, but having a more formalized capital vehicle, because it really would give us an advantage in the markets that we're playing in, to be able to acquire some of these smaller assets cash and quickly. Whereas trying to, put debt on them out of the gate, we're kind of in the same boat as everybody else we're competing against. It has been deal by deal. I think within the next 6 months, we probably will have a formal capital vehicle. I'm hesitant to use the word fund because we don't want to pigeonhole ourselves to that structure yet. But that's sort of where we're at.
Okay. And I remember this was a conversation we had, this was months ago, but it obviously had a huge impact with me. Early on, you said you had a mentor tell you to underwrite deals as if they were go to 10% once the fixed rate or the balloon payment hits, and then do it again at 18. And he told you to do that because that actually happened to him. So, what are some other lessons that these mentors have given you specifically around financing?
Yeah, that's a really good question. I remember that conversation very well. And I'll also say that I've been super lucky to have a couple great mentors in real estate. Guys that have been in it forever, that have lived through the savings and loan crisis, that have basically seen everything that can go wrong. This same mentor of mine was telling me about how at one point, like, I think it was during the savings and loan crisis, they woke up one morning and looked at his balance sheet and said that, he saw that he had about 60 million in assets and 180 million in liabilities. And that was a really interesting story of how he went back and kind of renegotiated with the banks and was able to stay alive. And sort of the takeaway from that with banking is, banks are more flexible than a lot of people think. A lot of people think the big bag bank, you're so pigeonholed into certain parameters, but in reality, they don't want to own real estate. They'll generally work with you more than you think. That was sort of the lesson bestowed there. But yeah, he did say to me point blank, like, because, you're underwriting these deals at the time, debt was 5-6%. This is before it went down to like 3.5%. But, underwrite your deals as if debt will go to 10%. And then again, if it will go to 18%. And his point blank said to me, because that's happened before, and it's happened to me, there's no guarantee that it won't happen again. So that really stuck with me. And, I think the takeaway was keep your leverage as conservative as possible. We do things a little differently than a lot of people. We do, no more than a 20-year AM. We try to do 10-year fixes, and we really focus a lot on principal reduction because, if you can ride out 10 years of pay down, your balloon payment is going to be a lot smaller than, some of the multifamily guys I know that were doing 30-year AMs, IO debt for 10 years, just to juice yield and maximize cash flow on the back end. So, we don't generally go higher than 65% LTV. We do long fixes. We've done a lot of long fixes in the last cycle. Just try to keep our leverage profiles conservative, focus on AM pay downs, and avoid recourse where we can.
Yeah, and I think with apartments, the value add strategy is very intuitive. You know, you're adding new countertops, you're, fixing the exterior of the building. Industrial is a little bit different in that regard. So how are you doing your value add play? Like, let's say you have a sale lease back and you plan to convert that to multi-tenant. Are you upgrading power? Are you putting in office? What does that value add strategy look for you on that?
So that's a really good question. And I'll say that in industrial, one way I was taught to look at it early on, that's been a big part of our value add strategy, is really as an entrepreneur, like taking the risk of buying these buildings, before the value's been added. What you're really trying to create as a finished product is a safe income stream that you can package and then go sell to some of the lower risk tolerance. So a lot of the value add is really financial engineering and creating stability within, and that's mostly done through lease structures. So, I'll get to the physical value adds in a moment, but really, if you can buy buildings with short leases or under market rents, and you can either, make them a safer, more stable income stream by putting creditworthy tenants in on longer leases, like a lot of value in industrial gets created that way. So that's one thing we look at is sort of how can we turn this asset with limited, maybe the weighted average lease term is like 2 or 3 years. How can we bring those rents up to market and then, increase that weighted average lease term to 7 to 10 years and have strong kind of creditworthy tenants. And I say creditworthy not in the sense of like AAA rated, like a lot of people think with the Class A stuff, but if you can make a case that the businesses that are in your building have been operating for a long time, they have strong positions in their market, that's compelling to a lot of investors. So yeah, we try to, maximize those lease structures, create stability that way. In terms of physical value add, big thing is lay down, maximizing the lot. So we've done a lot of that. We've upgraded power a handful of times. The one building that we 1031'd into, it had like a multi-split floor. So we brought the floor down. But, really, if the building's vacant, you want to make it as leasable as possible to as many different users. So if it's a tired, like dirty, old manufacturing building, it's whitewashing it so it shows better. Even stuff like landscaping outside can make a big difference. Upgrading lights from older lighting to newer LED lighting so it shows better. If there's office space, we have a very kind of strict formula that we use, the same fit and finish for every office that we update: lighting, paint, carpet squares. That's pretty much the extent of it.
Cool. And if you do get this, whether it's a fund or capital vehicle, where can people find out about investing in it? Of course, if you're an accredited investor, obviously, but how can they best get a hold?
I mean, I can be found on Twitter. I'm not that active on Twitter, but plan to be more so in the future. I can give my email to you. It's luke@chimneypondcap.com. We have a website that's launching within the next month. So that'll be chimneypondcap.com. And, happy to share my contact info with anyone that's interested just in investing or just chatting real estate in general.
Cool. Well, Luke, this has been awesome, man. Appreciate you coming on.
Yeah, thanks for having me, Tanner. Appreciate it. Good chatting with you.